A new tax law just kicked in, and depending on your situation, it could either save you thousands of dollars or it could cost you real money if you're not paying attention. I'm Nick Morrison, a certified financial planner based in Raleigh, North Carolina. I work with people approaching their next chapter, usually folks in their 50s and 60s figuring out retirement. Today, I'm going to walk you through the 5 things in this bill that actually matter and the one thing that I think most people are missing. So the one big beautiful bill, and yes, that's what they actually called it, passed back in July. And there's been a ton of coverage, but there's one problem. Most of it's been political, not very helpful if you're trying to figure out what this means for you. Here's what you need to know. Back in 2017, we had the Tax Cuts and Jobs Act. A lot of those provisions were set to expire in 2025. It had a lot of people worried. Are my tax rates going to go up? Is my estate going to take a hit? Well, this new law answered those questions. Before I get into it, this is educational content and not personalized advice. Your situation will be different. As with many things tax, there's a lot of nuance involved. This bill is filled with tiny little gotchas, but this will still be a solid framework for understanding what's changed. All right, let's get into it. First, tax rates, and this is what had most people anxious. Are they changing? No, the 7 brackets that we're used to, from 10% all the way up to 37%, are remaining the same, and that was made permanent. So if you were somebody rushing to do Roth conversions because you were fearful of a tax spike, you can slow down. You can be strategic and not reactive. That's good news. But the one thing most people are missing, that's coming up. Second, and I think this is the one flying under the radar, there's a brand new deduction for people 65 and older. They're calling it the Enhanced Senior Deduction. And here's how it works. If you're 65 and older, it's an extra $6,000 that you can take on top of all your other deductions. And if you're married filing joint and both of you are 65 and older, it's an extra $12,000 you can write off. Now here's the catch. It starts to phase out at a certain income level. $75,000 for single filers and $150,000 for married filing joint. For every dollar you're over that threshold, you start to lose 6 cents of your benefit. So who does this actually help? Retirees in the middle income range. If your retirement income is Social Security plus some modest retirement withdrawals, this could put some real money back in your pocket. And here's where it gets more interesting. Because of the way Social Security is taxed, the extra deduction could mean fewer of your Social Security dollars get pulled in as taxable income. For some retirees in the 12% bracket, this is a double win. An extra deduction and fewer of your Social Security dollars counting as income. I actually break this down in another video, the 3 biggest tax mistakes I see if you want to go deeper on that topic. So you need to run the numbers carefully. One more thing, the senior deduction is not forever. It's temporary. It runs from 2025 through 2028. So you have a window, but not forever. Third, the estate tax. This had a lot of wealthy families scrambling. Under the old rules, the exemption was set to be cut in half at the end of 2025. So it was going to move from roughly $14 million per person to near $7 million. It's adjusted each year for inflation. So families were rushing to do complicated gifting strategies, considering irrevocable trust, and other planning strategies that were very expensive to implement. That urgency, gone. The exemption is now permanent, and it went up $15 million per person starting in 2026. $30 million for a married couple, and it'll be indexed for inflation going forward. Now let me be direct. For most people watching this, the estate tax was never going to be a problem. Most families aren't anywhere near those numbers. But if you are someone with significant wealth, a family business, a concentrated stock, a lot of real estate, this means you can breathe. You don't have to rush into complex planning strategies. Fourth, and this tends to matter more if you're still working or in a high tax state, the SALT cap change. SALT is state and local taxes, and under the old law, you could only deduct $10,000. If you live in California, New Jersey, or say New York, that cap really hurt. The new law bumps it to $40,000 by 2026, and it'll increase 1% each year until 2029. Then in 2030, it reverts back to the old way of a $10,000 deduction. The new law bumps it to $40,000 starting in 2026, and it'll increase by 1% each year through 2029. Then it'll revert back to $10,000 in 2030. There are income phase outs here too. It starts to phase down at $500,000 of income. And honestly, for a lot of retirees, you were going to itemize anyway because standard deductions are so high right now. But if you're still earning, have significant property taxes, and a large mortgage, it might be worth running the numbers. Itemizing could make sense again. One more thing worth mentioning, there were some changes to charitable contributions as well. Now, for those that take the standard deduction, there's a small amount of cash contributions to charity that you can write off. Up to $1,000 you can deduct for a single filer, and up to $2,000 you can deduct when married filing joint. This didn't exist for those that didn't itemize in the past. But if you do itemize, there's a new floor. You can only deduct charitable contributions that exceed 0.5% of your adjusted gross income. So for example, if your adjusted gross income is $200,000 and you make a $20,000 deduction and you donate $10,000 to charity, only $9,000 is deductible. And for those in the highest tax bracket, which remains at 37%, your deductions or the tax benefit of those deductions are capped at 35%. A slightly reduced tax benefit compared to previous years. So here's the bottom line. The tax code just got more stable, and we have clarity on the rules moving forward. That makes planning easier. But the thing I pay attention to most, that new senior deduction. I use the cockpit analogy with clients all the time. You look at the cockpit and you see roughly 50 buttons and levers, but you're not really sure which ones matter, but the pilot does. That's what financial planning really is. Understanding all the potential variables, which levers matter the most for your situation. If this helped you understand what's changing, hit subscribe. I put out content regularly, just trying to cut through the noise and explain what really matters. Drop any questions in the comments, I read them.